Okay, let's dive into this. Have you ever wondered why human emotion always ends up being the ultimate final boss of the financial markets? Welcome to This Explainer. Today we're unpacking exactly how our own biology and psychology just completely hijack our logic.
Seriously, think about it. Why do our absolute best, most meticulously planned trades so often spiral into our absolute worst nightmares? It's a painful reality for so many of us, right? You put in the hours, you do the research, but then those innate biases creep in. Greed convinces you to hold on to a winning tech stock until it crashes all the way back to break even. Or fear steps in and you panic sell a perfectly solid asset at the absolute bottom of a minor 5% dip, blowing up your account in the process. It turns out our own minds are actively working against our best strategies. To kind of ground this abstract concept, let's look at a brilliant real-world anecdote from a day trader on Reddit who goes by Xanderdogs. They shared this incredibly powerful mental reframing trick to combat trade anxiety. Basically, they said, when I take a trade where my max loss is $100, I am spending that $100. It's already gone, so there is nothing to be afraid of. I mean, how smart is that? Treat it like a business expense, not a potential loss. Once that money is mentally spent, the fear literally evaporates and you can actually just execute your plan flawlessly.
Which brings us to the core of the issue, the human nature of the market itself.
Dr. Barry Burns points out something super fascinating here. We usually think of market charts as, pure math or cold hard economics. But really, charts are actually maps of collective human behavior. The market isn't just like people, it literally is people. Nothing gets plotted on a chart until a human being takes action. It's mapping their hopes, their fears, and ultimately their financial commitments. So you aren't just analyzing numbers on a screen, you're analyzing mass human psychology.
So let's talk about the real-world emotional traps we fall into out there.
Starting with a number that is frankly shocking, but absolutely vital to understand. 2. According to Kahneman and Tversky's famous prospect theory, our brains are biologically hardwired to feel the pain of a financial loss roughly 2 times as intensely as the joy of an equivalent gain. That means a $500 loss doesn't just sting your wallet. It triggers a deep, almost physical biological urge to make the pain stop immediately. And well, that leads us straight into the most destructive trap of all.
Revenge trading? To escape that intense 2x pain we just talked about, we fall into this emotional survival instinct. When you take a loss, your brain registers it as a physical threat, triggering a straight-up fight or flight response. The fight in this scenario is instantly taking another trade to neutralize the threat and get back to break even. You mentally anchor to your starting balance, and being below it feels like an unacceptable failure. So, what do? You throw logic entirely out the window, just to fix it right this second. The data analysts at TradesViz actually call this the cascade effect. Just look at how this progresses. Step 1 is a totally normal, pre-planned $500 loss. Fine, right? But because of that intense loss aversion, you panic and jump into step 2, a revenge trade with a bigger position size. And boom, you lose 800. Now you're really panicking. Step 3, a desperate Hail Mary trade and you lose 1,200. What should have been one single manageable bad trade has now completely cratered your entire account into a massive drawdown. It happens so fast. And it's incredibly hard to stop because of the sheer addictive nature of trading.
Trading is biologically addictive, period. When you profit, or honestly, even just anticipate a profit, your brain releases a flood of feel-good chemicals like dopamine and serotonin. And because you don't win every single time, but you don't lose every time either, the market acts as a partial reinforcement schedule. That is the exact same psychological mechanism used in casino slot machines. Add in the illusion of control, that false belief that your late-night research makes your strategy bulletproof, and the availability heuristic, where you vastly overestimate your chances of winning just because you've seen a few successful trades from others online. It's not just a bad habit, it is quite literally a neurochemical trap. So how do we beat biology? It comes down to choosing structure over emotion. And this brilliantly illustrates the core difference between amateurs and professionals, as legendary trading author Mark Douglas points out. The average trader is always out there hunting for some new magical indicator to avoid losses altogether. But the top trader? They look for a better mindset. True success in the markets is almost entirely about your internal attitude and your emotional control, not just your external technical approach.
Let's rapidly run through NinjaTrader's 5 psychology tricks that professionals use to enforce this kind of structure every single day. Number 1, commit to your exact dollar risk before you even enter the trade.
2. Detach your ego from the outcome. Always put the process over the profits. 3. Use mental rehearsal. Visualize the crazy volatility before it actually happens so you don't panic in the moment. 4. Track your behavior in a journal, not just your P&L. And 5. Think in probabilities. You have to accept that losses are just a statistical part of a winning edge, not a personal failure.
But what about a structural fix for that rapid revenge trading cascade we looked at earlier? It's surprisingly simple. Force a cooldown. When you take a loss, your cortisol, your main stress hormone, spikes wildly. This literally impairs the risk assessment part of your prefrontal cortex. You aren't thinking straight. By forcing an automatic, non-negotiable 15 to 30-minute break away from your screens, you allow those cortisol levels to physically drop back down to baseline. Now, let's shift gears and look at a fascinating technological solution for all of this: coding psychological risk. Researchers have been developing AI models that actually act as personal trading assistants. They're designed to calculate something called a trader's psychological risk index, or PRI. Basically, this system analyzes your unique individual behavioral vulnerabilities to flag moments of extreme emotional fragility before you hit that self-destruct button on your account.
The AI actually does this by translating standard trading data points into human emotions. For instance, if you have a low success rate, the AI flags a drop in your morale. What about a long winning streak? Well, that triggers internal warnings for overconfidence and greed. It tracks your active session time to identify mental fatigue, and it constantly monitors your overall balance to detect signs of financial desperation. So the AI is essentially reading your emotional state just by looking at your cold, hard numbers.
Now, what's really interesting is looking at the actual Python code driving this logic. There's a snippet here, max_loss_session, which calculates the exact time block in your historical data array where you tend to lose the most money. It literally iterates through all your past data to find your personal, mathematically proven kryptonite. Maybe it's Friday afternoons, maybe it's right at the open. It finds it. And here is the absolute climax of that Python logic. It uses a simple if statement to check your current trade index against that historically terrible session of yours. If they match up, the code automatically increments your psychological risk index score by 1. It beautifully bridges the gap between raw array data and human psychology by alerting you in real time. It's effectively tapping you on the shoulder and saying, hey, your data shows you usually revenge trade out of fatigue at this exact time of day. You need to walk away right now.
So after seeing exactly how our biology is hardwired to work against us and how modern data and code can reveal our absolute deepest psychological flaws, I want to leave you with this final provocative question. The next time you sit down at your screen, really ask yourself, are you truly trading the market, or are you simply trading your own emotions?